Payment Pulse, a podcast by ExplorePay, a leading full-service payment provider.
Welcome back to the Payment Pulse. Today we're talking about something every business owner depends on, and that's cash flow. Making sales is obviously important, but keeping your business running depends on when those sales actually turn into money in your bank account. To help us unpack all of that, I'm joined once again by Joe. Joe, welcome back.
Thanks, Noelle. Happy to be here. Cash flow is one of the biggest factors in the success of any small business. It's easy to focus on sales because that's the exciting part, but sales don't pay your bills until the money actually reaches your bank account. Whether you're making payroll, ordering inventory, paying suppliers, or investing back into your business, healthy cash flow keeps everything moving. That's why funding isn't just another feature of your payment processor. It's an important part of your overall cash flow strategy. The more predictable your funding is, the easier it is to plan ahead, make confident decisions, and keep your business running smoothly. And that's really what today's conversation is all about.
Yeah, and I think that's something that most business owners don't connect necessarily to payment processing. They know they're accepting payments, but they may not realize that their payment processor plays an important role in how quickly and how predictably they actually receive those funds.
Exactly. One of the questions we hear all the time is, I made a sale today, so when do I get paid? It's a simple question, but there's quite a bit happening behind the scenes between the moment a customer taps their card and the moment those funds are deposited into your checking account. Understanding that process helps you better manage cash flow and avoid surprises.
So let's walk through that. What actually does happen between a customer making a purchase and the money showing up in a business owner's bank account?
Most people picture it as money moving instantly from one bank account to another, but there are actually several steps happening behind the scenes. When you accept a card payment, the transaction first has to be authorized by the customer's bank to make sure the card is valid and the funds are available. Once it's approved, that transaction joins all the other payments you've made throughout the day. Now, at the end of the day, or whenever your system batches out, those transactions are submitted for settlement. From there, the card networks and banks complete the transfer of funds, and finally, your payment processor deposits the money into your business checking account. The entire process happens relatively quickly, but it isn't instantaneous. And while those behind-the-scenes steps are important to understand, what matters most to business owners is knowing when those funds will actually be available to use, because that's what drives your cash flow. It's not just about making sales. It's about knowing when those sales become working capital for your business.
And that leads into a question that we hear a lot. Business owners sometimes compare yesterday's sales to today's deposit, and the numbers don't match. So why does that happen?
There are a few common reasons. First, it's timing. Deposits based on settled transactions are not necessarily every sale you've made in the last 24 hours. If you process transactions after your batch cutoff time, they may be included in the next funding cycle. And second, adjustments. So depending on your processing setup, deposits may reflect processing fees, refunds, chargebacks, or other account activity. So it's completely normal for your deposit amount to differ from your total sales with all that happening in the background. The important thing is understanding why. When you know what goes into your deposits, reconciling your accounts becomes much easier and you're not left wondering where your money went. That kind of visibility is important because the more accurately you can forecast your deposits, the better you can manage your cash flow and plan for upcoming expenses.
Yeah, that's a great point because I can imagine seeing different numbers and immediately assuming that something is wrong.
Exactly. Most of the time, it's a simple matter of understanding how funding works. And that's another area where your payment provider should add value. Good reporting and clear explanations make it much easier to reconcile deposits, understand your cash position, and confidently manage your business.
So let's talk about funding speed. We hear terms like standard funding and next day funding all the time. What's the difference?
Standard funding typically means your deposits arrive within 2 to 3 business days after transactions settle. The exact timing depends on your processor, your bank, weekends, holidays, and when your daily batch closes. Next day funding shortens that timeline by making qualifying funds available the following business day. Now, getting your money a day or two sooner might not sound like a huge difference at first, but many businesses, it absolutely is a game changer. Now, think about a restaurant placing its weekly food order, a retailer restocking popular inventory, or a service business covering payroll before the weekend. When you know your deposits will arrive consistently and sooner, you can make those decisions with confidence instead of waiting to see if the funds are available. That's why I like to think of faster funding as more than a convenience. It's one piece of a stronger cash flow strategy that gives business owners more flexibility and peace of mind.
So faster funding isn't always about just getting paid sooner. It's about giving businesses better control over their cash flow and the confidence to keep things moving forward.
That's right. Cash flow is the lifeblood of every small business. Most business owners aren't sitting on unlimited cash reserves. They're constantly balancing incoming revenue with outgoing expenses. The more predictable your funding is, the easier it becomes to forecast, budget, and make proactive decisions instead of reacting to every deposit. That's one of the reasons funding timelines should be a part of the conversation when you're evaluating a payment processor, not just pricing.
So what you're saying is knowing when you'll get paid is just as important as getting paid quickly. Would you say that's true?
I would. Of course, getting paid faster is great, but knowing when you're going to get paid is often even more valuable. Business owners schedule payroll. They know when rent is due. They know when suppliers expect payment. They plan inventory purchases around busy seasons. When deposits arrive consistently, you can forecast cash flow, budget more accurately, and make better business decisions. It's the uncertainty that creates stress.
I think that goes back to something we've talked about in the past here on this podcast. Choosing the right payment partner isn't just about finding the lowest rate.
Yeah, that's right, exactly. A lot of business owners compare payment processors based almost entirely on rates, but a good payment partner does much more than process transactions. They help you understand your funding schedule, explain why deposits look the way they do, provide reporting that makes reconciliation easier, and give you tools that help improve your cash flow. Because at the end of the day, a payment processor shouldn't just help you accept payments, they should help you manage the money coming into your business. That's real value, and it's something business owners should consider when evaluating a payment partner.
Great. So before we wrap up, what is one piece of advice that you'd leave a business owner with?
Yeah, take the time to understand how your funding works, know when your batches close, know when deposits typically arrive, understand what affects those deposits, and don't be afraid to ask questions. Your payment provider should be able to clearly explain your funding schedule and help you understand what you're seeing. The better you understand your funding process, the better you'll be able to manage your cash flow, avoid surprises, and make informed decisions for your business.
I love that. So making a sale is only the first step. Understanding when that money becomes available and also having a payment partner that helps you manage that process is what turns your revenue into healthy cash flow. Joe, thanks again for joining us.
Always a pleasure.
And thank you for joining us on another episode of the Payment Pulse. If you found today's conversation helpful, be sure to subscribe so you don't miss upcoming episodes where we continue breaking down payments topics into practical advice you can use to run your business. We'll see you next time.